Let's talk about the real truth of this market. This market we are currently trading in 2023 is unlike anything that you have seen in the past. Parts of this market are doing exceptionally well, while other parts are firmly pricing in a deep recession. Think your bank stocks, your manufacturing companies, your retail stocks that are getting obliterated. There's a real divergence here. So what is really going on? What are the biggest data points and things to know over the next couple of weeks? What do I think is going to come out of this market? And specifically with Tesla, why am I so excited about this name? So let's jump into this video with what happened on Friday. So the markets went pretty parabolic on Friday. You've seen a gain of 1% in the NASDAQ, 2.12% in the Dow, and 3.5% in the Russell 2000. That move in the Russell 2000 is unrivaled so far in 2023. The Russell has really been getting destroyed because this is really your index of companies that are very sensitive to interest rates, very sensitive to inflation, and ultimately where the lending market goes. More than anything, more than the economy, these are the companies that really need to raise capital. And the data that we got today was a positive for these companies. And if you look at the data, it's the unemployment rate and the non-farm payrolls. Now, if you look at these numbers, non-farm payrolls came in at 339,000. You were expecting 190,000, a massive beat. Whereas unemployment was at 3.4%. It came in at 3.7%, a huge jump in unemployment. You were expecting a tick up to 3.5%. It went more than a tick up. That is very indicative of the Fed is about to pause. That's what markets got out of this. But most importantly, leisure and hospitality. This is one of the sectors that has been the stickiest with inflation. Think restaurants, think hotels, think other services related to the sector. It's where a lot of the job growth has been, where a lot of the inflation has been. This is the first report from the Bureau of Labor Statistics that we have gotten in a long time that leisure and hospitality was not at the top of the monthly job ads. You had healthcare and social assistance at 74.6 thousand, professional business services at 64,000, government at 56,000, then leisure and hospitality at 48,000. Normally, leisure and hospitality would be the biggest gainer, and then everything else would be under it. And that's showing that maybe inflation might start to come down in this sector. And it's a lot different from what we've seen in the past. Now, there's a good and bad, right? Obviously, with this data report, the unemployment rate jumping to 3.7%. If this trend continues, that's very recessionary. If you look at a chart of the last year of unemployment, you are at the highest level in a year. You hit 3.7% in August of 2022 and 3.7% in October of 2022. If you get another a labor report that shows the unemployment rate going higher than this, you're going to see some pretty recessionary data at that point. And you're already starting to see that in some of the manufacturing PMIs and some of the Chicago Fed data that we've been getting, and Philly Fed data and Dallas Fed data. Lots of data has actually supported that we're heading into recession. Short term, markets like that because the Fed's going to pause and then maybe cut rates at that point. Obviously, that depends on the course of inflation, but that's the market's overall perception. But let me tell you right now, this could come to an end this optimism by next week. The biggest catalyst that we're really going to have next week, on top of everything else, my opinion, is going to be the OPEC Plus meeting. Now, energy really feeds into everything. Whether, the product itself is made with oil, or if it's something you buy online, if you drive to a store to buy it, if a store ships a product or a distributor ships a product to the store, like literally everything you buy is affected by oil. So what OPEC said recently in a conference in Qatar, I know I'm not saying that right. Trust me. I know I'm not saying that right. They said, quote, "I will just tell them, watch out." And he said this about speculators betting on lower prices. And even more articles, maybe you could call them leaks, are coming out suggesting that OPEC Plus is going to cut oil production by a lot. And that could send up oil 5 or 10% depending on Monday, depending on how much they actually cut production. And that's going to be negative for inflation, negative for the economy, negative for everything. So that's a big catalyst we want to watch heading into this next week. The next biggest catalyst is going to be inflation data that comes in on June 13th. Markets are expecting the Fed to pause with a 69% probability. There is a 31% probability of a rate hike. But what's interesting is markets are actually expecting the Fed with a 51.7% chance to hike rates to 5.25% to 5.5% by July. Rates are currently at 5.25%. So they are expecting a rate hike in July, but a pause in June. So you really need to see inflation come down. Like, you really need to, because what happens historically when the Fed pauses, they usually cut about 90 days later, about 3 months later. And if the Fed pauses in June, that would be a cut September. That's kind of what the markets are expecting right now. And the Fed doesn't want to have to cut in September. So it's going to be very volatile from here. And you really need to see inflation coming down to support some of these valuations that we have in our markets. Now, at the same time, stocks are going crazy. Bank stocks, retail stocks, your other consumer discretionary names are not doing well. It's really the top 7 or so companies in the markets that have held all of the gains for the S&P and the NASDAQ in 2023. If you strip out just the 7 biggest tech names, markets would be negative. That's saying a lot. The NASDAQ is up like 20% for 2023. S&P is up 10% for 2023. It's been a pretty good year if you're in those big tech names or if you're invested in the indexes themselves. So that's kind of what we have looking ahead in this market. Now, my personal opinion on this market, I think you almost inevitably have to go into a recession. And why I think this, just me personally, is people are slowing down their spending. That's a fact. And I think what you actually got with the debt ceiling recently is going to help push us into a recession. And those are the student loan repayments. The average student loan payment is $278. And holders of master's degrees, meaning you probably went to school for a long time, have to pay $572 a month. This is not for private student loans, which never got that forbearance. This is for government student loans. And there's over $1.6 trillion of government student loans. This is the largest asset owned by the U.S. federal government. So what this is going to do is take out a lot of that discretionary spending. That is a lot of people's total discretionary spending every month. And when you really look at CPI, is it accurate? No, it's 100% not. You have seen prices go up a lot more than what CPI has said. It costs way more to go out to eat, to get a hotel room, to public transportation. A damn DoorDash costs a lot more now than it did before, among many other things. Doctor's visits, dentist visits, or really anything else. You name it, it's went up more than what CPI says it has. So I think you need to see a recession. I don't think it's going to be insanely deep. We'll see. But I think you need to see one to really get some serious disinflation, to let wages actually catch up to inflation, to get that spending in balance with the price increases that we have seen so far. Hell, even some deflation, I think, could be a positive thing right now. So by the end of this year, because student loan repayments start at the end of July, by the end of this year, you're going to be seeing some very recessionary data. And I don't think that's something the markets can be immune to. But from now until then, I think the markets do have some room to rally as people are optimistic about what the Fed's going to do, ultimately pause rates and then cut them by the end of this year. It looks like a plausible outcome if inflation continues to go down. Now, I don't think big tech's going to keep going up forever, but I think small and mid-cap stocks, even some of your larger stocks that really have not gotten that attention that big tech has, I think some of those names can start to catch up. And Tesla is in the big tech category, but it's not up nearly to the same degree as some other names. And recently with Tesla, you've seen some very positive things develop for this stock. Number one is advertising. I've talked about this in many videos now. If you watch this channel, you're fully aware that I think advertising with Tesla is going to totally change the game for this company. Think about, just in simplest terms, what Tesla has been able to do without advertising. Then imagine if they advertised and spent some money for advertising. What kind of sales volume that can bring in? Who cares about price cuts? With Tesla's margins, if they could double their sales, if they could get order books that they can't even fulfill because the production won't keep up, imagine what the stock's going to do. And I think that's ultimately the case by really the middle or the end of this year. Recession or not, people need to drive. As long as people are not losing their jobs in huge numbers, like a 5-6% unemployment rate, you can manage that. It's not the idealist situation, but we were there in 2021 and 2022. Take a look at the unemployment chart. I mean, you were at 5.5% unemployment throughout much of 2021. You were over 6% unemployment. Even at the end of 2021, you were 5.5%, almost 6% unemployment. That's manageable. Still likely a recession, but pretty manageable, especially in the auto industry. But another big thing that Tesla really has going for them as of right now is interest rates. Interest rates falling is going to be a huge benefit for Tesla. As Elon said just not too long ago, he said that, quote, interest rates have a very big impact on the affordability of cars, said Musk at Tesla's annual shareholder meeting in May, adding that he sees demand impacted for the coming few quarters. And Barron says peaking or falling interest could change his outlook and the outlook for other automakers' stocks as well. And I think that's the bottom line to it. Just realizing the Fed is going to pause, or when they do pause, and markets start to expect that cut, you're likely to see a boost to Tesla's share price. Not to mention, Tesla stock is breaking out from the levels we just seen, about $152 per share. Now you're above all of your major moving averages. You held up support on a technical basis perfectly at that 200-day moving average. You came down specifically here on May 31st. You wicked down to a low of about 195, ended up closing that day at $204 above your 200-day moving average. This was the test. If you were going to break under that, it was going to happen on May 31st. It did not happen. The day before that, you slightly broke under it, closed above that moving average. And then following June 1st, well, you came down, you touched that 200-day moving average, and then you rallied from there. And then you rallied on Friday. The stock's going higher. I think 250 to 300 is in the cards over the next couple of months. Depending what happens with interest rates, with inflation, with OPEC, with unemployment, with the recession data, I think that's going to play a role, obviously. But I think Tesla has a lot more to gain from here than to lose. And even if you look at this on a technical basis, in August of 2022, Tesla was, or peaked, at about $315 per share. You could see $100 of upside here in just the next couple of months. And that would still be about $100 exactly from its all-time highs. Look at a stock like Nvidia. Not exactly cheap, trading well past its all-time highs. So that's what I have for you. Ladies and gentlemen, thank you for watching. Hit that like button. Subscribe to the channel and let me know what you guys think about this down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.